How's it going, everybody? It's your private money surgeon Nick Billions here with another drive-by educational video, and this time the Mills Funding Group LLC, an apartment acquisition and asset management company, presents how a typical syndication offering is structured. Once again, we always have to offer a disclaimer up front to let you know that I am not a lawyer, CPA, or securities professional. This info is purely based off of personal experience and opinion and should be consulted and verified by your attorney, CPA, or etc. before moving forward with any mentioned investment strategies. This information is purely educational and not intended to present or market any securities opportunities. Now, for more of what we do as a company and what we offer, you can go to our main website, which is privatemoney.venecompanies.com. Now, how much to raise is always the big question that syndicators or the creators of the deal or sponsors think about before they go out and offer the opportunities for private money to get into the deal. You're either going to choose either 100% of the purchase price and reserves, or you're going to choose a down payment, which is the equity down payment and reserves. Now, of course, faster way is just to go for the equity and reserves because it's going to be less money, but the safest route and most thorough route is to choose 100% of the purchase price and the reserves. Reason being is because that gives you more options, not only for just one deal, but it gives you more options to down the road choose several deals to put their money into if this one deal doesn't pan out the way that you foresee it to be. Next, you want to calculate or present the investor units to prospects in their email, postal mail, etc., whatever form of communication that you've used to contact your investors. That's what you want to use to present these opportunities to. And in these opportunities, you want to let them know how many investors you're looking to invest into the deal, the price per investor unit, or how much minimum per investor is expected to invest, and the minimum total amount that you're going to invest into the deal before you move forward to put it on contract and close on it. Now, a quick disclaimer here is that a lot of investors, sometimes if they have more money, if they want more skin in the game, they usually go for more than one unit. So for instance, one investor may do two $200,000 units, which means they would do $400,000 total, but they'll fill up 2 units. If you all get it, okay? Now, for example, this deal right here shows you got 10 investors, $200,000 per unit, and a $1.6 million minimum, which means that we're looking for at least, if you're looking for just one investor each, that's at least 8 investors, or just a $1.6 million minimum buy-in before we move forward to put property on contract. Next, you want to choose your entity, which is LLC or LP, which is best for any type of real estate, not just offering. But in this case right here, you want to choose either offering, LLC, or LP, which is going to be the umbrella entity, and then within the entity you're going to separate the members, which are the managing partners and investors, from the general partner and investor. Each member is going to get an equal shares of stake into the LLC or LP, and the general partner sponsor will usually get an equal share or a slightly higher share, so that their controlling aspect of the entity can supersede anyone else's decision, so that there's no conflict of interest down the road. Now also you want to do an or option. If you were doing an LP, then you would have on the left side separate just members, which are just managing partners, and on the right side you have a syndicate management LLC as the general partner, which means that total liability, which means that pushes you personally from personal liability from the deals or from anyone trying to file any lawsuits against you down the road. My sponsor participation, which is simply my skin in the game or the syndicator's skin in the game. The purchase units is easier to sell the offering when you have skin in the game. So if you're doing one of the investor units and you show your commitment form in there, it is easier to show that. That's why the more the merrier. That's why it makes it better to bring people together instead of trying to do one at a time or one per deal. You also can do what's called a subordinated participating interest with no capital contribution. What that means simply on the next bullet is simply you want to negotiate your fees. You want to negotiate lesser fees in exchange for your participating interest without physically placing any capital into the investment, because all of the management acquisition fees coming to you is going to come from the take of the investors' private money coming into the deal, because you offer them the opportunity to get more money, to get a return on their money, and by bringing this deal to them. So that's why you're entitled to those management acquisition fees. Now, typically you would charge 3 to 5% if you were experienced and you weren't placing any skin in the game, or in this case you want to charge typically 1 to 2% if you want to charge less and give your participating no capital contribution interest into the deal. The syndication package, this is where the whole package comes together. But this, like I said, though, consult with your lawyer before you move forward with this, because there's much more than this, but these are the most important documents that's going to be part of the syndication package. You have your Syndicate Management LLC with the operating agreement, and you have your Syndicate LLC with the operating agreement. That's if you're setting up an LLC or an LP, one of the two. These documents are going to be in there to tell everybody their duties and shares into the entity. You have your subscription agreement, which is the one that the investor signs when they hand you your check. You have the investor suitability questionnaire. You have the confidentiality agreement. You have the purchase contract, notes, and mortgages if it's a debt offering, and you have disclosure agreements. Now, those disclosure agreements also include the joint venture agreement. I said joint, I don't know why. Probably typing too fast as I talk. The subscription agreement, or the PPM if you're doing a Regulation D type offering, where you had a certain amount of investors and you were raising a certain amount of money, which we will go into on one of our other drive-by educational videos. That's it, people. That's all I have for today. Again, this is the private money surgeon, Nick Billions, coming to you representing the Mills Funding Group LLC and Apartment Acquisition Asset Management Group. For more what we do and what we offer, you can go to our site at privatemoney.viniquecompanies.com. You can go onto our Facebook page at Mills Funding Group. You can go online and join us on Facebook, on our Facebook page at facebook.com/private money savior. We'll have the information up on our next few videos. Again, this is Nick Billions. I appreciate your time in this. I look forward to talking to you soon.